Okay, cool. Then I think let's get started. Welcome everybody once again to this Valuation Masterclass. Really glad that we've been joined by Egosa, who I don't think needs any introduction, though I will try to make a quick intro around him in just a second. So this masterclass is being hosted by the Africa Angel Academy. And the Africa Angel Academy is the premier angel investor academy in the continent, in Africa, by African investors for African anyone interested in investing in the continent. And in terms of how our program looks like, we're going to be running between now and we'll finish at, depending on your time, at 18:30 South African time. So I'll just jump right into it. We're going to do a quick intro into the Africa Angel Academy, and then after that we'll jump straight to a quick scene setting, just talking a bit about what the ecosystem looks like, what the environment looks like at the moment. And then after that, we'll jump straight to the session with Egosa, which I think everybody is really looking forward to. So as mentioned, we are really delighted that you've been able to join us for this session. Feel free to introduce yourself in the chat. I'm seeing lots of, the chat is, there's quite a bit of communication there. So feel free to intro yourself there, where you're calling in from. I've seen quite a number of people from across the continent. Really glad that you've been able to join us for this session. And we do this consistently. We'll speak about some of the other events that we have coming up in the next couple of weeks. I think next week we have another event coming up, which I think should be just as exciting. So please, wait till the end, and we'll speak more about some of the other sessions that are coming up. Okay, so that's the agenda for today. I'm gonna do a quick scene setting for a couple of minutes. I'll try and keep this short. 15 minutes looks like it's quite generous. And then I'll jump straight into the session with Egosa. I'll start out with a few questions that we've just discussed, just to set the context. But then we'll keep collecting questions in the chat. So feel free to type in your questions there. I think John is on the call, so John is going to be helping us to just sort out the questions, and we'll pick those questions towards the end and make sure we respond to them. And then at the end, we'll have a short session just about some announcements and some closing. So for those who are new, the Africa Angel Academy is an African-led initiative that looks to train early-stage investors, angel investors, and we have a self-paced online program, which we do on a cohort-by-cohort basis. And the whole idea about the Africa Angel Academy is really just to increase the number of active angel investors in the continent. We want to ensure that we have more local capital that's coming from the continent that's able to support startups, to solve some of the key challenges that exist in the continent. And we also want to help the investors to make better decisions so that they can generate good return. So far, we've trained over 488 angel investors. We've done 7 cohorts which have been completed. We are just running the 8th cohort. And this masterclass is part of the 8th cohort, though we chose to open it up to the entire ecosystem because we think valuation is such a critical topic to discuss at this time. We've done training in 15 countries so far. So we have an active alumni, some of the countries from South Africa, Nigeria, Rwanda, Mauritius. I could go on and on. You can visit our website, you can find out much more about that, but we've been doing this since 2020. There's 13 angel groups that have gotten formed through the Africa Angel Academy. After the training that we host, 13 groups have come out of that. We've done 40 plus master classes, and we're very proud that 48% of the people who go through our programs, or the angels who go through our programs, are women, because we also want to make sure that we get, as much funding. And if you know the funding statistics in the continent, there's lots that needs to be done to ensure that we address the gender aspect in terms of how much investment is going to female-founded startups. So we're very proud about that. We've had 15 angel groups which have been founded through some of the efforts that we've been doing, and over 50 plus guest speakers. We're very happy for this cohort. We've gotten a lot of support from the Dutch Good Growth Fund, which is the Netherlands Ministry of Foreign Affairs. And I'm really happy that we have Julia is on the call, Robert is on the call. They're from the Seed Capital and Business Development Facility. They've supported us to be able to train angels. At the moment, we're doing 5 countries. and we're really happy about that support. And we've been doing this since last year, and there's yet another year around the support that we're getting around this. So thank you very much, Julia. Thank you very much, Robert, for the support in terms of getting more angels trained in the continent. The Angel Academy has been put together by two partners. There's Viridian and the Victoria Business Angels Network. Viridian is based out of South Africa, and Viridian designs and delivers early stage entrepreneur and investor programs. And we've been working together for a number of years. I think Alex is here. I don't know, Alex, whether you want to say hi.
Hi, everyone, and so nice to join you from Lagos. I mean, so not from Lagos, from Accra. And I've been chuckling to myself because I'm sitting in a hotel lobby with the Andy conference, and I've just done a quick walk around the lobby, and there are lots of other angels joining us from Accra, and wonderful to be on this call. And a huge thank you to Egosa for joining us. So thank you so much. And I'm going to hand over to Stephen, as my internet isn't fantastic. And he and John will be able to tell you more about the African Angel Academy should they have any questions. But I'll be on the chat and try to answer those questions as we go. Thanks.
Thank you very much, Alex. I also want to, David, if we kindly just also say hi. David is also one of the partners and the promoters of the Africa Angel Academy. David?
Hi, Stephen. Thanks again. So hello, everyone. Thank you for joining this session. I promise you it's going to be great. I've had the pleasure of joining sessions with Egosa before, and yeah, it's super interesting. So thanks, Egosa, for joining, and then thanks also for the two partners, the Dutch Good Growth Fund, and of course the FMO, who are making events like this possible. So thanks a lot, Stephen. Over to you.
Thank you very much, David. I'm also part of the Victoria Business Angels Network, and we are based out of Nairobi in Kenya, and we make investments in startups across the continent. So really proud, being able to, be part of the Africa Angel Academy and the kind of work that's happening across the continent. So enough of the intros. I think let me just jump to the scene setting, right? Where we are now. And I'm just going to keep this very short so that we get to the real meat of the session. So, of course, valuation has been a big issue, and it's been a big issue because of what's happening around the ecosystem. And I guess if you want to paint a picture, one of the items you may want to look at is, number one, the funding side of things, right? And if you look at how funding has been, this slide tells a lot. The slide is courtesy of Africa, the Big Deal. If you are not already subscribe to the newsletter, please make sure you subscribe to the newsletter. There's really good content that comes out every week out of this. But just looking at the total funding and starting from 2019 into 2020, and of course 2022, 2021 being the year that really topped the charts, funding has moved quite a bit. I think last year we closed at somewhere around $4 billion that got invested into early stage startups in the continent. And if you look at this year, so far as at August, we are tracking at 1.3 billion, which is way below what we had in 2021 and 2022. Of course, that has had an impact from a valuations perspective, and we'll get to that in a second. If you also look at the data on a month-by-month basis, what you have here is that you have 2023, which is in the, I think this yellow, in the light yellow color. And then you have the other years, and you can tell that apart from a few months where the numbers were slightly higher than the previous years in terms of months, the numbers have been lower than that. But the impact of this is that it has affected the valuations for startups because at the end of the day, there's an element of demand and supply. If you look at 2022 at the height of the sort of like valuation craze, the numbers were really high. If you just take a look at some of the numbers here, 2021, 2022, you see some of the numbers that were there. And of course, the valuations were really skyrocketing as at that point. But then now just coming to 2023, as at this time, the numbers have come down. And the picture that you're looking at is not unique to the continent. If you go across globally and have a look at what the numbers look like, and this is from CB Insights, just looking at how valuations have been moving. And so here you have on a quarter-by-quarter basis, starting from 2022 all the way till 2023. If you look at the numbers, the later stages, valuation numbers have come down quite a bit, 60% in this case. This is Series D. And as we move towards sort of like the earlier stages, you see the numbers have also come down. This is 15% in the seed or angel stage. And in between you'll see the numbers. Of course, these to a great extent, for someone who's been making investments, it brings a bit of concern in terms of where we are at and how to appreciate these data, how to make investments at this point, and very importantly also how to think about how to support the startups during this time. And we've seen quite a number of questions coming up, asking, how do you take this kind of information? What does this mean from a valuations perspective? What does this mean in terms of from a return perspective? If I'd already made an investment, if I'm making an investment at this point, how should I be looking at these numbers and thinking about how I'll be able to make my return? And I thought, I found this on the internet, and I thought it was an interesting one just to have a look at, which was just how things have changed. And these are just simple terms, sort of like 2021, 2022. I mean, I have my own personal favorites here. There's this element of, we are renaming your price. And now all of a sudden, we always say that valuations do matter. I love this one, blitzscale ban, and we're going to be discussing these. And now, I think even earlier in the year, we had something from Sequoia that was just talking about financial discipline and so forth. But just this idea of just having a lot of fiscal discipline, which is something you didn't hear as much about, 2022 and before. Then there was the element of just keep hiring. We want to go for scale. And now we're saying, fire, why did you hire so many? At some level, people are talking about 200x ARR. Now people are talking about just being very sustainable and keeping things going, right? And this just starts telling you that the tone has changed to a certain extent. And I believe that, there's no one better to sort of like walk us through, what's happening in the ecosystem than Egosa we're going to be speaking to in a second. If I look at our Angel Academy and some of the questions we've seen coming up from the angels over the last couple of years, and especially where we're at now, these are the key questions that keep coming up. The first is, from a valuations perspective, you get the theory, but you always ask yourself, how do I apply it in practice, especially in this kind of context, right? And then there's this question that always comes up: how do you value startups realistically? How do you know that you've not overpaid for the deal that you're making, especially with the limited amount of information that you have, especially in the continent? And when you're looking for multiples and so forth, how do you ensure that you're doing, justice on the valuation side? Then, I mentioned this: how do you make sense of recent tech valuations, stock reset? I think we've seen a number of companies that have, raised at lower rounds. Some of these deals have not been announced publicly, so I don't want to quote any numbers at the moment. But we've seen a lot of that, where some startups which were on a unicorn status, we've had them looking to raise money at significantly lower figures in this case. And how do you support startups during these tough times? And then just the strategy for investing during these times. So that's really just the context. And as I mentioned, I don't think we have someone better. And I'm going to stop sharing my screen now because we're going to move to talk to Egosa. I don't think we have someone better to, peel off the onion or, just speak about this topic than Egosa. I have to say just a few things about Egosa before we get started. And Egosa, feel free to put on your video. I asked Egosa whether he could, come in and be part of this panel session. And I was really, really glad when he said that he was going to be available for it. And it's one of the panel sessions I'm really excited about because I think I'm also going to learn quite a bit about this. So for those who don't know Egosa, he's a founder and a managing general partner at EcoVC, which is a seed and early stage technology venture capital firm investing in underrepresented founders and in underserved emerging markets. So among the things he's been involved in, developing the thesis and sourcing investment opportunities in various companies, including including Facebook, LinkedIn, and several others. I think Pandora is also a part of that. He's been part of exits. It's not only made investments, he's also been part of different exits. There's a couple of exits that he's been part of, Sense Networks, Walkify, SmartZip, and so forth. And as per his profile, he enjoys collecting colognes and has a particular fondness for big dogs and loves football and cricket. If you don't know much about him, please make sure you follow him on Twitter. He's on Eghosa O. I love following him on Twitter because he shares some really interesting nuggets about just the general investing ecosystem based on his experience. And Egosa, I want to invite you to put on your video so that you can get started. Thank you so much for joining us.
Sure. I can't start my video, though. It keeps telling me the host has stopped it.
I think we'll sort that out in a second.
Okay.
Then we'll be able to sort that out. Okay, just as we sort that out, I am going to start out with the first question. Because I mean, I've set the context to a certain extent in terms of where we are at and where we're coming from. I think for me, the first question, and this is a question that comes up a lot, is a question around valuation and pricing. So, you know, it's a bit inexplicable for someone who, you know, deals, and I do a lot of valuations, but for someone who does a lot of valuations, when you look at the current numbers where startups which were unicorns just a couple of years back are raising funds at, you know, significantly lower figures. In this case, I think the record of a startup that was valued at $2.2 billion, I think now raising funds at probably $500 million. Some of them have been acquired at, you know, next to nothing in this case. How do you make sense of that? So what's valuation, what's pricing, and how does someone appreciate those two concepts for the investing journey?
Great. So thanks a lot for inviting me, and thanks to everybody that thought this will be an interesting enough conversation to register. As I was mentioning to Stephen earlier on, it's always very funny that the number one topic for founders and investors these days is valuations. There's nothing else. Every product, go to market, sales motion. Nope, nobody cares about that. Everything is about valuations. So I've been fortunate enough to have done a whole bunch of investments across multiple stages. So pre-seed, seed, growth, and a couple of pipes, private investments in public equities, and also been fortunate enough to have done a bunch of exits. And one of the other things in my sort of background is that I oversaw bankruptcy and restructuring activity, and so I've also done a bunch of shutdowns. And so everything from birth to life to death to resurrection, I have seen in the life cycle stages of companies. And so when we talk about valuation, right, a lot of that is just a construct for assigned value, right? And so a lot of investors tend to, and by the way, this is going to be, because your primary audience is angels, right? I'm going to assume that a lot of the investments we're talking about would be pre-seed, friends and family, pre-seed, maybe seed. Now, some angels do a little bit later. We'll go maybe into a Series A. But fundamentally, when we think about an angel that says, okay, I have $250,000 and I want to put $25,000 into 10 companies, right? At that point in time, you're really sort of trying to do sort of super early stage. And one of the challenges with that is that the earlier the stage, the greater the risk. And so when people talk about valuations, right, what you're really saying is, what is my expected value on the outcome, right, divided by the risk. It's fundamentally, it's a very simple construct. So what a lot of people were doing over the last 3 years was really that they were focused on the expected value of the outcome, because every day there was some new unicorn being birthed, right? Every day, right? Even in Africa, we had a fair share of, super high valuations, Series A deals were getting done at 100 million post, and so everybody was like, oh my gosh, I'm going to get rich. If I can find a company even at, 10 million, that has 2 months of revenue, Series A will get to 100, and I can exit or make my 10x. But as we found out over the last 2 years, that was just all an aberration, right? I was actually just looking at some numbers earlier on, and when I looked at global venture, and it's such an interesting chart, and thanks, Stephen, for even showing that, because you look at global venture going from like 20 billion to 52 billion to 26 billion to 16, right? And you can literally tell where the highest froth was happening in sort of 2021, and I'm still puzzled by the fact that, it was happening in 2021. You would almost not know there was a pandemic in 2020, right? And so I think, for all of us now, there's so many investors that have never gone through one economic down cycle, right? I mean, in fact, that was also true of a lot of founders, which I always was worried about, that there were founders and investors, right, that would have been in startups and investing in startups for 12 years and never really seen a down cycle, because after the last down cycle, the big one, which is sort of the Lehman one, so you could have been sort of investing from 2009 right into 2021, right, and thought you were a magician and thought you were great and thought you had figured it out. As venture would show to you, it's not true. It'll always come back and bite you. So how should you think about valuation, right? And it comes back to it, right? It is an expected value of an outcome versus risk. But there's also a third leg to that, which is the probabilities, right? So what you're really finding is that final number gets smaller and smaller and smaller as you add one layer on top of another. You'll be like, what's the expected value? Okay, it's going to be $100 million at exit. That's great. What are the probabilities of that happening? 1 in 10. Okay. Then you're like, so somewhere along the line, maybe if I do this deal at 1 million, right, I can get to an outcome, a probability set that allows me to sort of forecast it, maybe a 10x, right? So even if it exits at 10, which is the probability, right, I can still make 10x off my 1. That's really sort of how you can work it with that. Very, very simple, very laid back. But here's the problem. Problem is that founders don't believe that, right? A founder's responsibility in their minds is to maximize the valuation at every round. The challenge with that is that, and many of them really struggle to internalize, this were messages that were being sent even during the fraud. Every valuation exercise is an opinion. The founder has an opinion, the investor has an opinion. It's not a fight, right? But African founders you're getting very touchy about it. Like, it's not a fight. But what you do with the valuation is that you're making an embedded promise that you are going to perform and you are going to execute such that at the next financing, you have grown into the forecasted valuation. And what a lot of people forgot about was that embedded promise. So they wake up in the morning and say, oh, give me 10 million for a pre-seed deal. Well, guess what? As a rule of thumb, the expectation is that anywhere between 2 and 3x should be the minimum valuation for the next round. So if, for instance, and I'm sorry, I will run through examples, quick math, I won't make it too complicated. But if, for example, you're like, okay, you know what? We're going to invest 2 million at a $10 million post, right? So it's 8 million pre, 10 million post. So the founder sold 20%. But the company has no revenues. The trade is that, and you also assume that because as a pre-seed, a typical seed will be a minimum of 20 million pre on the next financing. 20, maybe 30. So the expectation of the founder is that that founder is going to use the 2 million and create enough revenue traction and momentum such that when that next financing shows up in 18 months or 20 months or whatever it is, they can make an arguable case to be priced at 20 or 30 million. This was how it used to work. 2x, 2x. That's how you create value. But everybody forgot that. So everybody now wakes up in the morning and says, hey, you know what? We're going to, raise a seed at 10 or 15, right? You have 3 months of data, but you're now 15 million. And then all of a sudden, someone will show up and say, oh, I'll do a Series A at 80, right? But when you step back and you go, okay, what have you done for the 15? You've now raised 50 million at 80 or 90, and you're doing 50,000 in MRR, monthly recurring revenue. I saw deals during the froth, one deal in particular, which I still marvel at, in part because I saw it again. It came back in the last few months, was done at 350 on $50,000 in pilot revenues. Not 50,000 MRR, $50,000 total in pilot revenues. And, they raised 50 million. And so they've come back to market. Of course, no one seems to be able to answer like what happened to all of that money and this and that. And they're doing about 1.2 million in ARR. So I've said, you raised 50 million to do 1.2 million in ARR. Remember what we talked about, the embedded promise. You breached the promise, right? And so so when I tell them, okay, you're probably worth 8 million today, people get upset. But I'm not the one that caused this. I'm just telling you what I'm seeing. So when angels are sort of thinking about this, right, you want to be founder nurturing, not founder friendly, because the founder friendly thing is bullshit. But you want to be founder nurturing, but you also want to be very practical, because funds have very different economics than angels, right?
Yeah.
A fund, the manager is going to get paid, whether or not the fund does well, because they get management fees, right? So that manager will get a salary. An angel can sort of go into this whole thing, allocate 250 grand of hard-earned money and lose all of it. And it doesn't help when investors say, if you go into angel investing, you should be ready to lose all your money, because that's not a great and positive message. But it is pragmatic and true, because I think as my career has shown me, the deals where I've said, man, I'm going to blow on these things, I made 3x. The deals where I could not even remember what the company did, I made 32.
Okay.
So hard to tell. But that's sort of a good backdrop on sort of how to think about that trade between angels and founders regarding how to think about valuation.
Thanks. Just a few things that I picked out of that, the whole idea of this probabilistic thinking and just knowing not everything is going to make it at the end. And I think at times we forget that, which builds up on this whole idea of building a portfolio, right? Which is what VCs do, which is what angels should be doing, because nobody knows what's going to be, big at the end. Then I really like this idea of also risk, that at the end of the day, you have a certain outcome divided by the risk, and we don't think as much about that risk element. Okay, so maybe, and I'm starting from the theoretical perspective, then we sort of like broaden out. Yeah, lots of people spend a lot of time building financial models. You ask a founder, they'll bring you these, fancy Excel. They've done the DCF that prove that actually the valuation is 350 in this case, because of how they're going to conquer the world and everything. So do you use financial models for your valuation? Do you use the standard methodologies, all the way from your DCFs, your market multiples, Berkus, whatever, there's quite a number of them, right? Do you use those? and how do you, make sure that they're realistic, right? Because at the end of the day, for someone who's starting this out, the message you don't want to send out is that it's part gambling. Just throw your bets on 20 of them, and the ones that make it, you make your money from that perspective. So how do you ensure that that valuation makes sense, and how do you use financial models?
So I've used almost every kind of approach to thinking about modeling valuations. The one thing I have certainly become, I mean, this has been years anyway, is that the DCF construct doesn't really work for technology companies, particularly software. And the reason why is that there's a terminal value in your DCF model, and that always has a sort of timeline T0 through T1. Unfortunately, technology companies will always screw with you, because I have seen, I mean, there's one in particular that a good friend of mine invested at the seed, right? He's just seen his first return 18 years after the fact, but let's ignore that for a minute. If you are DCF this company, right? As of year 10, there wasn't anything happening. The founder was still talking story and was still able to convince people to raise money. Year 15, the thing starts to look like it's going somewhere. Year 18, it has blown. So which DCF model are you going to use? That's why when we're doing sort of early stage, valuation analysis for software companies in particular, we go through the DCF exercise because it's just good discipline. But how much weight we assign to it, for me, it's almost zero. But why would you do it anyway? Because in a bunch of scenarios, you have to triangulate your valuation outcome or your valuation range, right? So you talked about Berkus, you talked about DCF, you talked about multiples. You're using different approaches to come to a range, right? But the funny thing is, all of those approaches require assumptions. And good assumptions require good judgment. Good judgment comes from experience. It doesn't guarantee it, but you can see where it sources from. And so I think, in our preliminary sort of pre-call, I talk about the fact on my website, I occasionally share IC memos that I did for investments that I, wanted to do. And LinkedIn is on there. And, and you will see in that deck sort of how I use different valuation approaches to sort of come up with the number. But here's the secret. Because a lot of the VC world has sort of, gotten into we'll buy 20% for our money, the dilution, right? A lot of people just started to work backwards. So it's like, well, I want to raise 20 million. So therefore, the valuation is 100. Why is it 100? Oh, because I want to raise 20. Are you worth 100? Oh, no one's trying to touch that, right? And so you will run into that a lot, and don't fall for it. Work through the discipline around where's this company today? What are the assets it has? What is the unfair advantage that it carries? What secrets do the founders know about the product and the market and the opportunity that almost no one else does? Why do you think these founders will be able to capture that opportunity? Have they shown sort of a proclivity for building quality products? Can they go to market? Can they sell? Right? So you're looking at all these very subjective and qualitative things, in some cases quantitative. And what you're really doing is building a valuation model of comfort first. Then you now sit back and say, okay, great. Today, because the founder is not selling you what the company is worth today. The founder is selling you what the company is worth tomorrow. Right. But you're using today's money to buy tomorrow. So everybody has to come to some sort of middle ground. And the middle ground is, how do we figure this stuff out? So I look at a company today, it says, oh, we're worth 20 million bucks. And I'm like, why? Like, well, you know, and you see this with a bunch of the incubators and accelerators who talk about, you know, growth, right? And growth rates are a very important component of how you think about valuation. Because if a company is growing, you know, 7% week over week, which is what you see in a lot of the YC things, you know, or 30% month over month or whatever it is, why people are more willing to impose a higher valuation on those is because if you think about it, a high growth company today for a software player, forward multiple, right? So in other words, what you're forecasting for next year's revenue. So not this year's revenue, next year's revenue. Usually that changes after June 30. But next year's revenue, you just assume the company is going to do 2 million, right? So today, maybe today it's doing 400,000, right? But because of its growth rate, right, its current growth rate, you can extrapolate and say, look, next year to do 2 million, which is, you know, it is interesting, right? Because it's a 5x off of the current run rate. So you're now saying, well, if it does that 2 million next year, and the forward multiples, the median or the average, whatever you want to use, will be 10x, then I would 10x that revenue number, which is 2, and I would say, okay, today its valuation is 20. All right. Now, what's interesting with that example is that you're using the 10x because 10x is the multiple for high growth companies. So companies that are in excess of 50% or 100% year over year growth. But if certain companies don't hit that growth curve, then you see a low multiple. So you might be a 30 or 35% year over year growth company and your multiple is 4x. Right. And why that's interesting is that if you're a 30, or let's use 30, or right? So if you think about it, you're like, okay, the company's run rate is 400,000 today, right?
Yeah.
At a 30% growth, it's 520. 520 times 4x is 2 odd million.
Yeah.
So you can see the difference, what growth rate can do to not just the forecast for the revenues, but also the multiple you attach to it. So that's sort of how you would think about, okay, this is where it is. Now, we laugh about this, but there was a time when people were paying 200x forward, right? 200.
Yeah.
And sometimes when I think about it, I'm like, man, you're not even a pastor. And you are sitting out there with the confidence to tell me that, because the 200x multiple sort of implies that your growth rate over sort of a 5-year curve is going to be almost, it's 500%. Maybe 400. Yeah, 400%. Somewhere around there, right? So you're growing 4x year over year.
Yeah.
Right. So year 1, you did 1 million. Year 2, you did 4. Year 3, you did 16. Year 4, you did 64. So now, if that is true and that holds, right, that by year 5, you're sort of 250, 260, then of course I will pay 200 for it today.
Yeah.
Because at 260, there's a multiple attached to that. But then why am I so confident you're going to keep growing like that? I'm not.
Yeah.
But a lot of people were confident enough to say, sure, no pastor walk, they don't have anything, they cannot predict anything. But no, I can do that forward multiple. And that was outrageous. And what was even more outrageous was that the founder said, you know what, that's the market we're in, that's the game we've met on the field, so let's play it. But the flip side to high valuations, which I've talked about, is the expectations on the founders. I cannot tell you how many of these founders who did high valuation deals, no one talks about their mental health. Because a lot of them are slowly realizing that they will never meet the expectations set by those valuations.
Mm.
Now, a bunch of them, they took secondaries, so some of them don't care. They say, that was the game I met on the field, so I played it. But, a lot of investors have long memories, right? But everybody sort of had to accept fault, right?
Yeah.
And I think that's one of the challenges that I think that we all have to deal with now in terms of sort of digesting the bad decisions, right? And we'll get to that sometime in there. But yeah, those are some thoughts on that.
Well, thanks for that. I mean, so much just to pick out of that. Good assumptions come from good judgment, and good judgment comes from good experience, right?
And bad experience.
We always and bad experience, definitely. And I guess maybe from bad experience much more times, because you never forget a bad experience. You always take it with you into the next round and so forth. So you raised something which I want to just delve on. These sort of like hyper growth, where we've seen startups that have grown really fast. And this is blitzscaling, right? There's even a book about blitzscaling, how you do this and how you grow really fast. You raise a lot of money, and at times I feel as if you buy your customers, because some instances, the customers you bring on board cannot really afford the product. You're subsidizing the product for them to come on board. And so you're almost, that growth we are speaking about is not a sustainable growth. And I feel as though then you end up where your customer is no longer even the customer you're serving, but the VC, because, they're the guys who are going to pump in money, right? I remember reading the book on WeWork, right? And it was something similar where they were just sort of like going for it. It was like, dream as big as you want. We'll give you as much money as you'd like to, raise to be able to do this. So I guess a couple of questions from this. The first one is, what's your view about that model in the continent? Because I think some of the devaluations we are seeing, in my view, are purely because of that aspect where, you grew too fast, you got in customers, and then finally, when the money dried out and you really wanted to tell the customer, okay, now pay for the product at the right price, the customers cannot pay. And so then the numbers start coming down, and you need, or maybe that it's just not sustainable at the end of the day. And so you need to raise more money, and then there's no one on the other side to give you more money to sort of like, sustain that valuation. And I guess the impact of this is two things. One, you have companies that then, the goal was go big, go home, and there's sort of like no middle ground of sort of like, if it doesn't work, what do we have to salvage for this? So question, what's your view about that model in the continent? And secondly, how do companies then, and even as investors, as we're sitting with founders, how do we help founders to transition from, you'd gone for it, everybody had told you this is the way to go, and finally it's not working. So how do you transition back to sort of like, let's build a sustainable business? And I'm going to add another element onto that and still remain sexy to the investors, because I've seen situations where then at that point, investors are just like, we never invested in you, so to do the traditional things, we still want you to be that unicorn. So if you're going to do that, we've fallen out of love with you, we're going to look at someone else.
So the concept of blitzscaling, I think, is attributable to Reid Hoffman, and I think his co-writer, Ben Kasnoka, two people I know really well, deeply admire. I mean, I was willing to back Reid, with big money, for LinkedIn. But if you do a search for me on Twitter with blitzscaling, you will see how I questioned it. I thought it was bullshit narrative. And I also felt that what it really tried to ride was the zero interest rate phenomenon, right? And unfortunately, someone once called it easy money, the easy money phenomenon. But what you then have these very weird economic incentives, right, created by economic distortions. And I always said, look, this blitzscaling thing was probably the worst thing that ever happened to tech. Because what it really masked was the weaponization of capital. Right? So those who were able to assemble capital then went on this reign of terror with the capital. And, it was all the, go big, go home. I'm just going to take, I'm going to win, right? And I'm going to take all the competitors out and so on and so forth, right? So, you look at WeWork, which is a classic example of what blitzscaling looked like, raised $22-23 billion, right? It's worth about 200 million today. So it's worth about 1% of what it raised. You're not even talking about creating a value or even retaining value. It's worth 1% of what it raised. Which is startling. But I was complaining about blitzscaling. Now, what was fascinating to me when we bring it back to Africa was that there were so many people, founders, that, whether openly or behind my back, challenged a lot of the concerns I shared about it. When I said it doesn't work for our markets. And unfortunately, what the zero interest rate phenomenon also created was that as Africans, we forgot how to be capital efficient. Now, we learned how to be capital efficient because we didn't have access to capital, right? So it meant that even the big companies we built got there, it just took them longer, right? But all of those skills and learnings we lost when they said, oh, here's capital. Then you now look around, the capital showed up, now it's gone. The capital showed up, and please show me how many of the big companies you created. All of that capital, woof. All the lessons we learned from being capital efficient, gone. So we learned nothing from blitzscaling. It didn't do anything for us. Nothing. I mean, how many unicorns? Okay, even back then, not even now, because now, it's a completely different thing. But how many unicorns were actually created with all of that blitzscaling money? How many unicorns exist today? All right. So we talk about the growth of, oh, Africa's, it's 2 billion, it's 4 billion. I'm looking around, I'm like, okay, you raised all of this money. How much is it actually worth today? The money that was raised, not the value that was created, just the money that was raised. So what I think the market has sort of turned is there's sort of this renewed focus on, and I loved what it used to be, the Matt Turk thing, the tweet, like, oh, burn, then now it's like, don't spend. And it's funny, but tragic and painful, because I think one of the concerns I had, as VCs, I guess, we'll just have to take the blame for it, is that you're asking for founders to be schizophrenic, to essentially have multiple personality disorder. Because one was, oh, let's go. And then literally in 1 month, you're like, no, you can't go anymore. Higher. No, you have too many heads. You got to get rid of them. And that is whiplash. And as people who have had whiplash will tell you, it has long-run effects. Some visible, some not. All right? And so you then say, okay, so now that we recognize the long-run effects from this failed blitzscaling narrative, how do we solve that for these founders? because you're asking them to learn new things that you never encouraged them to learn before. Right? And that's why I said it's painful and it's tragic, because unfortunately, many of them are not going to learn it. Many of them are going to shut down their businesses, which they're doing now, right? And I guess the other thing that's sort of interesting and, always puzzles me is I was at an event yesterday with a whole bunch of founders, and someone says, so what does it take to get money out of you? Right. And, I said, that's a good question. I said, I always have to figure out, what the sort of key elements of the founder I'm talking to, what they carry. But there are these two things in the backdrop for African founders who operate in Africa. One of them is the risk of fatigue, because everything takes longer. Everything is swimming upstream, and I'm not even talking about the ones that are in regulated industries, right? But everything just, fatigue. The other, and to be honest, is that many of these companies shouldn't ever raise VC. They shouldn't. Too many founders and too many investors got in the whole, we must do VC with sort of these deal structures of VC. But a whole bunch of companies are not VC. Because one of the key distinguishing factors of venture-backed companies is rapid growth. Now we talk about, big markets, yes, and whatever it is, absolutely. And I mean, I don't know which market in Africa is not a big market, right? Especially when it comes to digitalization of anything. But many of these companies really shouldn't get VC. And we too have learned it along the way, And, people say, well, what does that mean? Well, I'm like, the valuations have to be lower and the terms have to be different, right? The company may never get to may never exceed $6 million in revenues. But if it is well run, it'll be spinning off $2 million in free cash flow. So the way you would structure that deal will be not for an exit, but for dividends. Because no one's ever going to come and buy that company the way they do with VC-backed companies. That company's never going to go IPO. Nope. But it's going to be a good, solid, free cash flow generating company. And the investors can be like, hey, you know what? I can do that. There are a few of these, unicorns, in Africa, some known, some not, that, have spun off enough cash dividends where the investors are 2x, 3x. Companies have not gone public. They might not actually go public. But when you are in a company, you've been there 12 years, you return sort of 3x, maybe, in some cases, maybe 4x. On an IRR basis, that's actually not bad. You're in the high teens. There are many VC funds that don't get there. So, those narratives need to die. The blitzscaling, all of that stuff. They just need to die. I think they're dead now, but they need to die again.
Yeah, I guess the real challenge, and I think you alluded to that, is going to be, and I saw a post around this, the kind of carnage that then initial investors will have to go through, right? Because if you invested at the top, of the curve, and now you're where you are, the dilution, if the company needs more cash, the dilution is going to be excessive. And then, it just boils down to sort of like, how do you make a return out of that, right? And I know you've alluded to dividends, but even if it's dividends and sort of like you're a super minority, and just imagine this also from an angel perspective, because most of the people, most of the audience that we speak to are angel investors, who then just worry about what does that mean, sort of like when that dilution is happening, when you're having the down round, you're moving from, I don't know, $2 billion to $500 million. that kind of dilution is ridiculous for an initial investor.
It is brutal. It is absolutely brutal. And by the way, you're also assuming, and we talked a little bit about this, and it's probably worthwhile talking about valuation and terms.
Yeah.
Very, very different. So let me give you a real life example of what that looks like. Very well-known fund in the US had invested in a company, and the company raised a bunch of money. And but you know, it had a whole bunch of articles, positive press, all that good stuff, but it was just, you know, the business was not really doing that well. But there was a piece of the business that was actually doing better. So they were like, cool, no problem. We want to go raise a new round. So a new investor shows up and says, okay, this company is not worth, you know, the existing investor, tier one VC, was like, okay, I'm happy with a flat round. I think it was 175. And the new investor was like, this company is not worth 175. But the existing investor was like, well, I'm fundraising and I can't take a markdown on this deal. So they came to agreement. The new investor would do the deal at 175, 175 valuation. But the liquidation preference was 5x, because the real valuation was 35. So the press was, oh, they raised money at a flat round. But it wasn't flat, it was a down round. And so the angels and everything that saw the, you know, because they may not have had access to all the direct information, because as these companies get bigger, they don't share information with smaller investors. They're like, oh, okay, good, my money is safe. But guess what? When the company hit exit, right? That new investor took all of the exit because of the liquidation preference. Every dollar. All prior investors saw nothing. Every dollar. So when we talk about, oh, valuation, I'm like, that's cool. Show me the terms and I will tell you what your real valuation is. So even with the examples we're seeing, you know, for African unicorns and this and that, the numbers get thrown around. I'm like, I know nothing about this stuff until I see the terms. Now, 3 years ago, you know, 2 years ago, sure, you know, everybody was doing clean terms. So when you saw valuations, they were like, yeah. But today, I mean, you show the chart, like the Series Ds are down 60%, right? But those are valuation numbers. What you've not shown me is what the terms are. So if you, I mean, like I just explained to you, I can show you a flat round that is 20%, 80% discount. That example was a flat round that was really an 80% discount. But if CBE Insight shows you the chart, they'll tell you something about I'm like, no. So I think a lot of that is of concern, because many folks who invested at the highs are very likely going to lose all the money. And the reason why is, you know, I've done a few of the recaps. You know, recap is a recapitalization where you go in and say, okay, fine, I'm going to invest in this company because I still think there's something there, but all the prior rounds, you know, don't reflect sort of where it is today. So we're just going to recapitalize it. And that can look in many ways very ugly, because I can take all the preferred stock, make it common, push it down. I've seen where investors that had preferred stock, they get common 2 and the founders get common 1. So the founders common is priority to the investors common, right? Because at the end of the day, the people who are going to run the business are the founders, not those investors, right? But they can, you know, these recaps can be so ugly that many investors don't even want to do them. right? And they already have existing investors there. They have relationships and so on and so forth. So they won't touch them, which means that this company is generally failed. But there's some recaps that have turned out to be extremely successful. There was one in particular a friend of mine did. I think it came down from 200 to 10. And they eventually sold it for like 240. Right? So it can work. But you've got to be almost a sociopath to be able to go into that.
My goodness, wow. Those are
but then again,
those
there are many sociopaths in private equity and VC. So we have many of them. So that shouldn't be a problem.
I think it goes to something I'm getting out of this, that as an early stage investor, as an angel investor, where you're not taking anything, you're not getting any management fees, you could lose it all, right? I think it's about time we go back to the fundamentals that when you're evaluating deals, don't leave out the FOMO, right? Because the VCs who are doing this and so forth, they'll make their money. The founders will do their secondary deals at a certain round, and you're gonna be left at times holding the baby, so to say.
That is the takeaway. You should put that. That is the summary of this conversation. What you just said. You leave out the FOMO and realize that even the game you're playing, the people around you are playing different games. My dad always used to say, if you want to know the game you're playing, study the rules. Don't look at other games. The game you're in, study the rules. And so when that FOMO thing is so interesting because it drove a lot of the decision making, right? And that's why you see this all the time: hot deals, hot deals, hot deals. And I used to say this thing years ago. I was like, some of the very best companies I saw, their deals were not hot. It was almost consistent, right? And when I think about some of the large companies today, when Travis brought out Uber, I think his valuation was 5 or 4, right? You see this a lot. Stripe, a lot of these companies, those first rounds of first money they took in, 5 or less. That's all changed now. Now you can't even see a deal, for less than 25. But that said, that is such a key takeaway. Right. And, we talk a little bit about, and this is sort of an interesting thing. You have to be self-aware that I think the best investors have what I call the two-sided coin of awareness, self-awareness and situational awareness. And on the self-awareness side of the coin, you have to ask yourself, why would this founder want my money? What is it about your money that makes it special? Right? And you also have to be crystal clear about that, right? And then the situational awareness then is like, okay, so am I just capital? And a lot of people's egos get in the way and they're like, oh, I don't just want to be capital. It's fine. It's absolutely fine. You can be just capital. It's great, no problem. When you go and invest in, in Snowflake or you invest in NVIDIA on the public markets, do you think they care about your value add? You're just a shareholder. You're just another shareholder, right? So it's absolutely fine. But a lot of people are like, oh yeah, he's going to let me in at a 30 cap. Mm-hmm. And I'm like, no, you're the bag holder at a 30 cap. Mm-hmm. You're the person that is going to make the founder be able to tell other investors that he really wants, or he or she really wants, that 30 cap is the number. Because he was able to assemble a bunch of bag holder angels who had absolutely no price discipline.
Egosa, I'm thinking you're running out of time. I feel like we just started. And really, there's a bit of pressure on time here.
No, let's see what questions there are.
There are some questions on the chat here. I want to just pick one or two.
Busy.
Yes, it has been. It has been. So let me just pick one or two that I've seen. So I think Linda asked a question. We've discussed this whole idea about founder fatigue, right?
Yeah.
We've just shifted founders from one spectrum to the other spectrum, and they're having to learn new lessons, right? Yeah. So practically, how do you help founders through that? Because at the end of the day, if the founder gives up, you're toast, right? Because they still need to believe in the vision, and I like saying they need to keep driving the bus because we are all passengers, right? So that's one question, and I want to join it with this second one. I think from Sechu, who says, you mentioned this whole idea that some of the dreams we had of IPOs may not come up, right? We better forget about them. And so, what's your view about sort of like M&As in terms of trying to address some of these, some of the companies that probably are in very tough positions, and how those could potentially be able to generate some returns for the angels and keep the dream alive to a certain extent? So those two questions just to start with.
So I think the thing about founder fatigue is one that has always worried us from the very beginning, right? Just because, Africa is a riptide when you're an entrepreneur. You won't see it. It's lurking below the surface. It'll drag you down. It'll drown you, right? So you always have to be. It's not just being able to say, okay, I know how to swim, because even riptides will kill the best swimmers, right? But you also have to be able to have help, right? People who can, rescue, that are always on site, on deck, watching full alert. But even then, still hard, right? Because we also have this backdrop of culture that does not seem to allow us to be transparent and vulnerable about our fears, and feelings, and weaknesses, and mental health. That's a problem. Even the whole construct of pivots, I don't remember whether I was on Twitter or whatever it is. I was like, people never talk about pivots. Every pivot takes a little bit out of you as a founder. It never comes back. It takes a little bit out of you. It bites you. It's a hole, right? It doesn't get filled. So when people are like, oh, just go pivot, because they have missed expectations, the promises that were never met, never kept, never fulfilled. There were visions that were never achieved. There's always a hole. So understanding that backdrop and understanding that mental health shows up every day. People talk brave, they talk game, this and that. It's a problem. And, I was just saying this yesterday, that, we say this all the time about how the job of a good investor, of a committed investor, is also partially that of a therapist. Because the emotional volatility and dynamics of being an entrepreneur, especially in Africa, on a different level. Now, it's not that you're not, you don't have the same emotional volatility and dynamics in the US, right? But just Africa is just hard because, it's one thing when you're like, man, work was tough, but then work was tough, you come home and there's no light, right? Or there's no fuel. There's all of that stuff that just, makes everything just really hard. So even sort of being able to, I do remember, I think at the beginning of the pandemic when we realized that, people were going to have to stay home. And I remember we took money out of our own pockets and bought diesel and bought airtime for our founders and their teams, so they could work from home on a whole bunch of things, right? But it was designed just to take one less worry off of them, right? And I think as investors, we should always keep that in mind. What is one worry I can take off of you as a founder? Being founder friendly is not that you give the founder the best valuation he or she wanted. That's not being founder friendly, right? I always say this, right? Character is measured at rest and emotion, right? And so who are you when everything is at rest, and who are you when everything is in motion, right? And who are you most importantly when no one's looking? So those are sort of key things that we try to pay attention to. And on the M&A thing, we talked about this, a very well-known saying, I can't remember who said it many, many years ago, that great companies are never sold, they're bought, right? It's a well-known saying, right? And if you're going to get sold, you're in a position of weakness automatically. Right? Unless you have some big PE money and whatever it is, and you're a big operating business, then, then you're going to bring all the boys into the yard. And then when you bring all the boys into the yard, then there's bidding, and then there's competition, and a whole bunch of things. And maybe you get a even better outcome. But for M&A, right, there's two sides to every story. I led M&A, my prior life, and there's the what do you think you're worth as a founder? The company is sort of looking to sell, and what are you really worth? All right, and usually those two numbers are very far apart. And there's a third facet, which is what do your investors think you're worth? Because of course investors are like, well, I bought in at X valuation, so you should be this or that. And you're like, oh, I'm worth 30 million. I'm like, but you're doing $200,000 in revenues every year. You'll be happy if someone gives you $1 million in stock, right? So, I think for founders that are thinking, okay, you know what, I can't raise, and I don't have enough of a business to make this sustainable, then they need to sort of be proactive about calling the investors and saying, look, we need to figure out how to sort of shut this thing down. So a company just raised money a few days ago. Just its entire service is helping other companies shut down. Right. So I mean, you just think about that. It's just hilarious to me. Right. But for these sort of exits and these sales, a lot of them will tend to be distressed. But I tell all founders, you don't necessarily have to shut a company down. Do you have a company that you can cut down to the minimum and keep going? And while you keep going, you don't have because once you cut down to the minimum, whatever it is, investors that say, oh, you know what, you're never going to amount to anything, they just leave you alone. And maybe leaving you alone is the best thing that can happen to you. Because then you can now go do your experiments, you can potter, you can figure out how to get customers, and you can do that. And, there's so many stories of these types of companies. They grew, they had all these expectations, nothing ever happened, investors left them alone, wrote off the investments, and the founders eventually just puttered along until one day they were like, we hit the gold mine on something else. But you have to be brave to have those difficult conversations. And you have to find the 1 or 2 or 3 investors that are going to be willing to support you through those conversations. And this is why I always say the founder-friendly trope was nonsense, because it was always, ooh, he gave me the valuation I wanted, he didn't ask for a board seat, he didn't do all these things. But then now, when you're calling them, asking them for help, they're like, who this? New phone. Sometimes the same phone, who this? Right? So I think a lot of founders are learning lessons now. And I'm really glad, because I think coming out of this, they're going to be a little bit smarter and they're going to understand. And sometimes it's not the valuation that makes a quality investor.
Yeah.
Someone asked me this yesterday, just to finalize, like, how do I grade myself as an investor? Very random question. And I said, I'm the second call. And she goes, what do you mean? And I said, the founders that I've built really good relationship with, because they're very mission driven, they have integrity, they do the right things, and they're okay being vulnerable. Those founders, I'm the second call, because the first call usually is the co-founder, but I'm the second call. And it's good news, it's bad news, it's in between news. But it doesn't matter, right? Because those are the kind of relationships you want to build. But everybody's sort of doing shakara, I'm a big shot, I'm sending tweets saying I got traction and momentum. Oh, I'm looking at a lot of these companies, I'm like, I know you don't. You don't have any money in your bank accounts. Yeah. So
I guess, as I say, it's when the tide goes out that you know who's been swimming naked.
Yes.
But I really like, the point of being a therapist to a certain extent with founders, and this idea of just, what pain, what one piece of pain can you take away from the founder to support them through this? Now, we only have time for one last question, and I feel like there's so much that's coming. But I think this question has come up a couple of times. This is a question of saves and convertible notes. Right? Yeah. So there's, of course, couple of investors who participated in safes, some in convertible notes. There was a valuation cap. The picture had already been drawn, but now we're in a position where that picture is no longer true, and you have to come down to reality. And so you need to revalue this startup. Maybe you're not even doing around at this point, right? So how do you go around now, sort of like repricing all that? You'd already signed on the dotted line. This was the figures we're looking at and so forth. We're waiting for a price round. That's not going to happen in the near future, but you need to price your portfolio. You need to get a sense of where exactly are we so that you can go back to market. How do you deal with that?
It's brutal because you have a lot of constituencies that are not aligned, right? So I saw a lot of folks who were raising money at 25 million caps, 30 million caps. And you tell these investors, this cap is not the valuation. You tell the founders that this cap is not a valuation because a cap is technically supposed to bear with it the belief that the next round is going to be higher than the cap. So when you're like a $25 million cap, let me give you an example. I'm raising $2 million, $20 million cap. A lot of founders are like, yes, I'm only selling 10%. Yeah, that's true if your next round starts at 30 or 40 or 50. If your next round starts at 10, then you still have 2 million that is going to have to get paid one way or the other. So if you raise 2 on a 20 cap and then you now raise 2 at a 10, valuation price, you will have sold 40% of that company. Well, you thought you were worth 20 at some point, and you weren't. So a lot of what has to happen is people have to come to agreement on what today's price is. The classic song from this guy who used to be on Puffy's label. He has this song called Diet Coke, and it's such a great rapper. He has a song called Diet Coke, and the song's that was yesterday's price, but that's today's price, right? And it's a great thing because that's really what we're seeing right now, which is that was yesterday's price, but then that's today's price. And so you have to ask yourselves as founders and investors, what's today's price? And you're actually better off, I think, for founders with these convertible notes. You don't want them floating. Right? You don't want people, and convertible notes tend to be safer for investors than safes because investors are just naked and floating with safes. Convertible notes have terms. You can exercise that. You can enforce. You can do a bunch of things with that. But everybody sort of has to come to agreement like, what's today's price? And then I think the founders are better off encouraging these deals to get priced. And the reason why is because then you know exactly what your ownership is. Because what you don't want to do is to wait for a VC to come and do this. Because, VCs have very interesting ways to approach this. Even your valuation always has a discount to it because your option pool goes into the pre. Right? So you're like, oh, yeah, it's 8 million pre, 10 million post. Yeah, but technically it's not 8 million pre because I'm going to ask for a 10% option pool. So it actually works out to be somewhere around 7 million, not 8, right? So these things matter, but it's very critical. And then I think one final point is that as investors, you have to figure out whether or not these founders want to keep going, right? Because you don't want to spend all the time and the energy and the intellectual resources and the money and the headaches to try to get some of these deals sort of done when the founder is sort of done, has moved on. There are a bunch of companies out there that are still talking. Meanwhile, I know founders have started other companies. They've raised money. You wonder who raised money, didn't due diligence on the prior company. But yeah, so they're drawing salaries from 2 companies. They're still sending stupid updates. But meanwhile, they've actually started doing other things. Yeah, and this is going to be another topic, which is the integrity of both founders and investors in the ecosystem. Very challenging. But yeah, those are my thoughts on that.
Wow. I wish we had more time. And I think we probably have to get you back, because I'm looking at the chat and the questions. I think Scott had asked one of the first questions. I'm gonna just read out the question, and you can probably just answer that. Then we'll wrap up. And Scott was just asking, we have now VCs who used to do much later stages, and they've come very early, and it's disrupting sort of like the angel side of things.
Yeah.
I mean, I know there's a deal we were sort of like participating in as an angel network, and sort of like as we were sort of like putting our papers together and putting ourselves together, a VC came and doubled the terms.
Yep.
And we had already agreed on a deal in principle.
Yep.
So how do you explain these, and how do you see the ecosystem looking then going forward?
Oh, it's real simple. The VCs are, again, incentives and outcomes. The VCs are incentivized to show activity, because a lot of them are not investing. So you can show activity by, and they've all raised money. They have to deploy this money. So in your case, price matters. In their case, just deployment matters. You're not on the same side of the table. So, he or she wants to do a deal, wants to put in 3 million, right? So you're like, okay, we'll put in 500K as angels at a 3 million cap, right?
Yeah.
You're thinking, okay, that's great. The VC says, I want to put in 3 million. I want to own 20% of this thing. I'm going to do it at 12 pre, 15 post. Because remember, they're operating on ownership.
Yeah.
Right? So you're like, wait a minute, that was a deal it's going to be 5x what I was going to pay. Of course, you're not going to do that, because that's not a good deal for you as angels.
Exactly. Yeah.
I keep telling angels, like, you really shouldn't be doing deals over 2.
Mm.
You really shouldn't. The math doesn't really work for you.
I know, Egosa, there was a question around the math of sort of like angel. I wanted to ask you that question, but I think we're going to take this offline.
No,
probably go to
what I would recommend is that you should, just capture all the questions, just so that if we'll have to do a follow on, because there's so much more.
We have to.
But capture all the questions so that I can sort of take my time and sort of answer them or whatever it is, and then you can sort of post them or whatever it is. Because I know lots of people have different questions, some of them from very specific situations they're involved in. But like I've always said, all the stuff that I've learned over the years, my responsibility is to just turn it around and share it, so people don't make the same mistakes I did. Because I made a whole bunch of them. I still do, but hopefully, as a group, we can make fewer and fewer mistakes. And if we do make mistakes, we should only make new ones.
Wow. Thanks, Egosa. I was thinking of what's the quote I'm going to pick out of these, sort of like in terms of everything we've discussed. And I think I'm going to go with the first one that I mentioned earlier, that, the thing about good assumptions come from good judgment, which comes from good experience. And I think it's all about, listening to, people like you who've done these, have seen sort of like everything you've done from birth, as you mentioned, to sort of like growth, to sort of like death. And then sort of like people pick out the insights out of everything. Thank you so much. We are going to get you back. We're going to take you up on that offer so that you can just keep spreading the gospel and get more angel investors in the continent doing deals and doing them the right way.
Yeah.
And hopefully this message also goes to the founder side. So the recording will be shared, but I want to invite, Egosa, thank you so much. Absolutely. I want to invite John very quickly to make a quick announcement, and then we're going to wrap up. But we will bring Egosa back, and we picked all the different questions. John, take it away. Thank you, everybody.
Some stuff. Cool. Sorry, can you hear me?
Yes, we can hear you.
Okay, great. Awesome. Just quickly, I'll try and do this a bit briefly just because of time, but thank you so much, Stephen, for being such an amazing host. And thank you so much, Egosa, for being our valued guest speaker today. Just a bit of a recap. This event is usually an event that's exclusive to our cohort members as we run training programs. So we've decided to open it up because there was a lot of interest in this particular topic. So we do have another event coming up next week, which is also open to the broader angel community, which is our Angel Connect event. The theme is sort of what does the future of investing in Africa look like? Lessons from the past to understand the future. That will be next week, Wednesday, on the 20th of September at 5 p.m. South African time. you can kind of check the Eventbrite link to attend. But we will also send a follow-up email after this call to everybody that has registered to this event with more information. And there you'll be able to see the events we have coming up, as well as be able to register and join. And then we also have our startup showcases happening at the end of October and beginning of November, where we give an opportunity for our angels to nominate startups that they're either considering or that they have mentored in the past. And gives them an opportunity for them to hear pitches and potentially invest or co-invest with other angels on the call. So that will be happening as well. But again, more information will be sent on the follow-up email after this call. But I think that's all from me. And again, just a really, really big thank you to Stephen and Egosa for today. It was a very valuable session. I know there's a lot of questions that we didn't get to, so we will try our possible best to get answers from them and share them as well. Over to you, Stephen.
No, thank you very much, John, for the announcements, and really looking forward also to the session next week. I think that's going to be a really awesome session. Please make sure to join that. I think I've seen lots of questions whether we're going to get the recording for the session. Yes, you will get the recording for the session. And as indicated, for those questions that we did not answer, we will pick those questions, answer them and share them. Hopefully we can get Egosa back. We'll look for him and we can have yet another session. But from us, thank you very much for attending. I think we are right on time. So we will stop there. Egosa, thank you so much. I don't know if you have any closing remarks, but we're going to wrap it up now.
Yeah, no, I'm grateful to everybody for attending. We are merchants of hope as investors and founders that are going to change the continent and change the lives of those who live on the continent and for those who don't live on the continent but are interested in the continent. And so I think, even in this market, in this backdrop, where hope has been questioned, we should never forget that that's what we are. We're merchants of hope. And so, yeah, valuations may change, but hope never dims. So let's keep investing.
I love that, Egosa. I like the fact, remembering that we are all doing this, not, the returns is one a piece of this, but at the end of the day, there's the impact that all the founders are having, the problems that are getting solved on the ground, and we cannot stop just because of this. We just have to keep going at it because we have to make sure that we build a better continent. So thank you so much. Thank you. Everybody, do have a nice evening. We're going to wrap up now, and we look forward to seeing you in the next session. Have a pleasant evening.